The world's largest pension fund is quietly betting on the survival of coal. Japan's government pension investment fund, with over $1.5 trillion in assets, holds billions in shares of companies that mine and burn it. This isn't an outlier. From California to Norway, the retirement savings of teachers, firefighters, and civil servants are anchored to the continued profitability of the most carbon-intensive fuel on Earth. The contradiction is absolute. The financial future of millions who will live in a warming world is tied to the industry heating it. This is the energy historian, uncovering the hidden systems that power civilization. And this system runs on a single, brutal financial mechanism. That mechanism is the yield curve. Pension funds don't just need returns, they need predictable, long-duration income streams that match their future liabilities, the monthly checks promised to retirees decades from now. For a century, that match was found in government bonds, but today, in a world of near-zero interest rates and quantitative easing, the bond market cannot deliver. A 30-year US Treasury yields barely 2%. To meet an assumed 7% annual return target, pension managers must hunt elsewhere. They have been forced out on the risk spectrum, into equities and infrastructure, into assets that generate cash flow from real things in the real world. And few things generate cash flow as reliably, for now, as fossil fuel infrastructure. Think of a pension fund as a massive machine with one job: transform contributions today into guaranteed payments 50 years from now. The machine's calibration depends on a discount rate, the assumed rate of return. Lower that assumption, and the present value of future liabilities explodes. Cities and states would have to immediately inject hundreds of billions they do not have. So the assumption stays high. The machine must therefore find high-yielding assets. It finds them in private equity funds that own pipelines, in utilities that operate coal plants, in mining conglomerates. The system is not choosing coal over climate. It is choosing solvency over immediate bankruptcy. The entire edifice of public retirement rests on a bet that the energy transition will be slow, orderly, and profitable for incumbents.
This dependency was engineered in the 1990s during the Great Bull Market. Pension assumptions were ratcheted up, fueled by the dot-com boom and a belief in perpetual equity growth. When those bubbles popped, the high return targets remained, locked in by political promises that could not be taken back. The gap between what was promised and what bonds could deliver became a chasm. This chasm created a multi-trillion-dollar vacuum, sucking capital toward any asset class that could mimic the old bond profile: long-lived, cash-generating, and essential. Fossil fuel infrastructure, with its decades-long asset life and inelastic demand, fit perfectly. The energy system of the 20th century became the collateral backing the 21st century's retirement promises.
Now follow the money one step further. When a pension fund invests in a private infrastructure fund, that fund doesn't buy a coal plant out of nostalgia. It performs a leveraged buyout. It loads the asset with debt to boost equity returns. The plant must then generate enough cash to service that debt and pay dividends. This creates a ferocious financial incentive to maximize runtime, fight premature closure, and lobby for capacity markets that pay plants just for existing. The retirement income of a public school teacher becomes structurally aligned with the political power of a coal plant in Ohio. The financial instrument is neutral, the physical outcome is locked in. The scale of this entanglement is staggering. The top 10 US public pensions have an estimated $90 billion invested in energy and natural resources, heavily weighted toward fossil fuels. In Australia, pension funds own vast stakes in the coal export terminals of Queensland. In Canada, they are major investors in oil sands pipelines. Divestment campaigns have made headlines, but they often merely shift ownership from one fund to another or to private equity firms with even less transparency and longer time horizons. The money doesn't leave the system, it just sinks deeper into its plumbing. The system appears to be transitioning, but its financial foundations are pouring concrete. This leads to the central, counterintuitive truth. The pressure to keep coal alive is not coming from rogue CEOs or corrupt politicians. It is emanating from the actuarial tables of pension funds. The timeline for shutting down a coal plant is no longer set solely by environmental regulation or gas prices. It is set by the maturity schedule of the debt stacked against it and the distribution requirements of the retirement fund that owns it. A plant becomes a financial vehicle first, a power station second. Close it before its debt is paid off, and you trigger a write-down. That write-down is a broken promise to a retiree. The political firestorm from a cancelled pension check is far more immediate and potent than the distant threat of climate change to a trustee board. We've seen this structural conflict before, in the death throes of the British coal industry. The UK's nationalised coal mines by the 1970s were deeply unproductive, kept alive by massive state subsidies. Why? Because the National Coal Board pension scheme was one of the largest in the country, supporting hundreds of thousands of retired miners and their families. Closing pits meant not just unemployment, but imploding the retirement system for entire communities. The financial liability of the pension was a heavier anchor than the weight of the coal itself. The Thatcher government didn't just battle unions, it had to untangle and resecure these pension promises before the mines could be shut. The energy transition was delayed for a decade by retirement obligations. Today's version is global and financialized. The mechanism is the same. Intergenerational promises made in one energy era become immovable objects in the next. The California Public Employees Retirement System, CalPERS, is a climate leader in its public statements, yet its private equity portfolio is riddled with fossil fuel exposures because that's where the target returns are found. The fund is trapped. If it divests too quickly, it misses returns and jeopardizes its funding ratio. If it doesn't, it faces climate risk and public outrage. Its solution is engagement, using its shareholder weight to ask oil companies to transition. But engagement requires holding the stock. It requires the company to remain profitable enough to transition. The pension's need for cash flow directly softens the pressure for rapid change. So we arrive at the mechanism line, the compressed truth of this entire system. Pensions aren't invested in energy. Energy is invested in pensions. The coal plant is not primarily a source of electrons. It is a source of yield. The pipeline is not just a steel tube for moving oil, it is a fixed income annuity with a 40-year maturity. The energy infrastructure of the past has been securitized, tranched, and sold into the portfolios that fund our future. This creates a perverse stability. The system resists sudden change not because of technological inertia, but because financial models are built on the assumption of gradual, managed decline. A rapid phase-out would be mathematically equivalent to a market crash for these funds. This asymmetry defines who wins and who pays. When a pension fund's fossil fuel investments underperform due to climate policy, the loss is socialized. It becomes an unfunded liability, covered by higher taxes, reduced services, or lower future benefits for retirees. But when those investments pay off because the transition is delayed, the profits are privatized, flowing to the fund to meet its obligations. The risk is borne by the public purse. The reward for extending the fossil era flows to a specific beneficiary group. It's a transfer between generations, mediated by a spreadsheet. The ultimate fragility is now visible. The global pension system is a supertanker of capital, requiring steady, high-calorie yield. The energy transition, by its nature, is initially capital destructive for the old system. It requires writing off stranded assets. These two realities are on a collision course. Every climate agreement, every carbon tax, every renewable subsidy is, in financial terms, an attempt to devalue the collateral backing the world's retirement savings. The tension is not between good and evil, but between two forms of security: financial security for the aged and physical security for the climate. The real question is no longer whether we can build a clean energy system. We can. It is whether we can rebuild the financial architecture that has wired itself irrevocably to the old one. The pensions dilemma reveals that the energy transition is not an engineering challenge. It is a debt restructuring of civilization. We must either find a new source of risk-free yield for $50 trillion in global pension assets, or we must collectively agree to absorb the catastrophic write-downs. There is no third option. Most people assume the biggest obstacle to phasing out coal is a lack of political will. Drop your answer below. I'll break down why that misunderstands where the real power resides. If this changed how you see the system, subscribe. The hidden infrastructure is always there. Now you know where to look.